Welcome to the IMA Statement of Cash Flows tutorial. In this tutorial, we will explain the basic use of a statement of cash flows, the various components of the statement of cash flows. We will distinguish the differences between the indirect and direct methods of preparing statement of cash flows. You will be taken step by step through the process of preparing a statement of cash flows using each the indirect and the direct method. In order to accomplish our course objectives, this tutorial will take you through the following contents: an overview about the statement of cash flows. We'll start with the direct method of preparing statement of cash flows, specifically reviewing cash flows from operating activities, after which we will complete a quick knowledge check on the materials presented to that point. This will be followed by reviewing the preparation of cash flows from operating activities using the indirect method, and a quick interactive review exercise to test your comprehension. We will then continue by showing you how to complete cash flows from investing and financing activities. And this will be followed by a second knowledge check. After this knowledge check, we will explain the reporting differences between IFRS and US GAAP, and a brief summary of our achieved objectives. You will then be prepared to take your CPE credit examination for this tutorial. Let's begin by providing an overview about the statement of cash flows. When used in conjunction with other financial statements, the information found in the statement of cash flows is widely used by internal management, external auditors, potential investors, banks, and other creditors such as vendors and leasing companies. By properly analyzing the statement of cash flows, one can determine a company's ability to generate cash needed to meet critical debt obligations and sustain the overall growth and financial health of the organization. Historical cash flow information is often used as an indicator of the amount, timing, and certainty of future cash flows. It can also be used to gauge the accuracy of previous cash flow forecasts. As businesses expand into global markets, the need for a common global accounting framework becomes more important than ever before. The International Financial Reporting Standards, or IFRS, is attempting to establish a global framework that will satisfy accounting consistencies worldwide. However, it is important to note that there still remain differences between US GAAP and the IFRS regarding the treatment of specific cash flow-related accounting and reporting items. As we further delve into the details regarding the statement of cash flows, we will bring these differences to your attention. To begin understanding how a statement of cash flow works, let's start by reviewing the typical bank statement you may receive in the mail from your bank. Typically, our bank statement will show us our beginning balance, the cash into our account, the cash disbursed from our account, and the ending balance in the account. When a bank statement comes in the mail, we typically reconcile it to our checkbook to make certain we've recorded all transactions properly and that no errors were made in the record keeping by us or the bank. For our purposes, we will refer to the cash in and the cash out as cash flow, as it reflects the flow of cash itself through your account. The statement of cash flows for a company is merely a document which explains the cash flow in a formal financial statement. Essentially, the document answers the question, how has our cash position changed? Where understanding cash flows usually becomes confusing is in distinguishing between things like actual cash received from sales versus sales which include items sold on credit, which have not yet been collected, or perhaps other accruals we've made to record sales we've recognized but haven't collected. Regarding expenditures, it can get confusing distinguishing between the actual expenses paid versus expenses recorded on our books but not yet paid, or expenses we've accrued for but haven't yet paid. Let's begin looking at our statement of cash flows by taking a look at the categories and components involved in the statement of cash flows. To answer how our cash position has changed, the statement of cash flows will follow a very specific structure in classifying cash movement. The cash movement or cash flow will be broken down into three categories: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Cash flow from operating activities are those activities that pertain to the main operations of the business. Any cash flow used to generate revenues, including expenses associated with each, is considered operating activities of a business. The amount of cash flows arising from the day-to-day operations of the business is considered a key indicator in determining if the entity generates sufficient cash to repay loans, maintain operating capabilities, pay dividends, and make new investments which will further benefit the growth and financial health of the company. Cash flow from investing activities include those activities that are related to the investments made by a company that will result in a recognized asset in the balance sheet. Types of investing activities can include either an investment in or disposal of long-term assets such as buildings, equipment, land, or even investments in stocks of other companies not held for trading nor available for sale. Cash flow from financing activities include those activities that go into obtaining funds from outside sources. These activities include obtaining or paying off a loan, the issuance of stock, paying dividends, and buying or selling of treasury stock. Although the statement of cash flows always reflects these three types of activities, there are two different methods used in preparing this financial statement: the indirect method or the direct method. The only difference between the direct method and the indirect method is in how we derive our cash flow from operating activities. Both the cash flow from investing activities and the cash flow from financing activities are prepared the same way using either method. To complete our statement of cash flows, we will need the balance sheet, the income statement, knowledge of the business activities and transactions which impacted the movement of cash during the specified period, and specifically for the direct method, we will be looking to our cash receipts and cash disbursements journals to piece all of the cash movement together. The first three components are needed for either of the two preparation methods we mentioned earlier, known as the direct method or the indirect method, whereas the cash receipts and cash disbursement journals are primarily used for the direct method. Although the direct method is considered by some to be easier to visualize, it tends to be very cumbersome to assemble and time-consuming to validate. Perhaps it is for this reason that the indirect method is by far the most widely used in business. It should be noted that both the direct method and the indirect method are permitted by US GAAP and the IFRS. Since it is often considered to be the easier method to initially grasp, let's briefly go over how the direct method works. First, remember that the cash flow from investing activities and the cash flow from financing activities is handled the same using either the indirect method or the direct method. Cash flow from operating activities, however, is handled very differently. So as we look exclusively at the direct method, we will only focus on the cash flow from operating activities. Much like our personal checkbook registers, companies keep track of their cash balances by monitoring the cash going into their bank accounts by way of deposits and other bank credits, as well as cash going out of their bank accounts by way of written checks, electronic fund payments, transfers, bank fees, and other types of disbursements from the account. Let's discuss how this typically occurs using a small retail business as our example. To determine the cash going into this small retail business, we'll look at our cash receipts journal, and to determine the cash going out of the business, we'll look at our cash disbursements journal. Under the direct method, we'll look at our cash receipts journal to document cash movement relating to operating activities, including things like cash collected from customers, perhaps they paid off an invoice or reduced the amount of money they owed us, also known as accounts receivable. Cash collected from interest owed to us on loans we made or bonds we purchased. Cash collected from dividends on stock we own in other companies. And any other cash going into our account which is not related to investing or financing activities. We'll discuss the investing and financing activities in greater detail later in this presentation. Operating activities would also include any cash payments we made, such as cash payments made to suppliers, either up front to pay an invoice which has become due, or to pay down any previous debt or money owed to our suppliers. cash payments made to our employees for things like regular salaries, incentives or commissions, or perhaps special bonus payments made, cash payments for interest we owe on loans we took or bonds we issued as a company, cash payments to the tax authorities to pay the taxes we owe, and any other cash disbursements made not related to investing or financing activities, which we will discuss later in this presentation. Once we've documented all cash receipts and cash disbursements relating to operating activities, we must validate our data by analyzing the company's balance sheet and income statement. To begin this validation process demonstration, we are first going to audit our cash in figures. For this example, we will assume that we only documented collections from customers, interest received, and dividends received. We will assume that we found no other cash in. Let's start by looking at how we validate collections from customers. To do this, we will first need to look at our income statement. In this example, we are looking at revenues for the full year 2011. According to our income statement, we see that sales revenues totaled $185,900. We know, however, that not all sales are paid for in cash. Sometimes a company may make a sale by extending credit to the customer, allowing them a certain period of time before payment is actually due. In order to determine how much of the $185,900 in total sales reflects cash which has not yet been collected, we must look at the comparative balance sheet. The comparative balance sheet will show us the current period and the prior period for comparison purposes. In this example, we also show a column which clearly identifies the increases or decreases in account balances reflected on this financial statement. Since we know all sales do not necessarily reflect cash being collected, we will use the comparative balance sheet to next analyze how our accounts receivable have changed during the corresponding period of sales, which in our case reflects a full year. Looking at our accounts receivable balances, we notice they were $58,500 as of December 31st, 2011 versus $47,450 the prior year. This reflects a year-over-year increase in accounts receivables of $11,050. In other words, $11,050 of our sales is represented by an additional extension of credit to our customers, which effectively means they still owe us the $11,050. Since our sales revenue figure reflects total sales, we'll need to subtract out the portion of sales which were not yet paid for in cash. In this case, we've determined that amount is reflected in our increase in accounts receivable of $11,050. After we deduct this amount from the sales, our net collections from customers should be $174,850. Next, we'll look at interest received. As we look at our income statement, we notice that this interest was $7,800. The next question we must ask is, does all or part of this figure reflect accrual entries? To determine that, we must look at our balance sheet to see if any interest receivable exists. In reviewing the current assets section of our balance sheet, we can identify that in fact no such interest receivable exists. Just as we did for interest receivable, we must apply the same validation process to dividends we receive. Using our income statement, we see that dividend income was $5,850, and again, we must determine if this income reflects any type of accrual. As before, we look to our balance sheet for further validation. We don't see any accrued receivables for dividends, so we can add that to our cash receipts and validate it to our cash receipts journal as well. As we scroll down our income statement, we do note another source of income which may translate to cash in the line item gain on sale of plant assets. It is considered to be part of the cash flow from investing activities and will be discussed later in this presentation. So, our validation concludes total cash receipts of $188,500, which should tie into our figures from our cash receipts journal. Now that we've completed validating the cash receipts, let's move on to our cash disbursements relating to operating activities. The first section we'll look at under the cash payments are funds paid to our suppliers. As you can imagine, suppliers can mean many different things, such as suppliers of inventory, office supplies, coffee we provide to our employees, legal or accounting fees, and any other number of items we have paid for. We will also want to look at funds paid to employees, cash disbursed for interest due on loans besides those funds paid to our employees, for income taxes, or any other disbursements we may have made which don't relate to investing or financing activities. Just as we did in the cash receipts side, once we've documented all of our cash disbursements, we'll need to validate these numbers using our financial statements. We'll start this validation process on the cash disbursements by focusing on our supplier payments and looking to our income statement for validation. Let's begin by focusing on cash payments for inventory. Again, we're going to look at this as though XYZ Company is merely a small retailer. We're doing it this way because it is really the easiest way to comprehend this material. As we look at our income statement, the first expense item we want to consider is cost of goods sold. We see that our cost of goods sold was $101,400. Let's start the validation by recording these costs. Although we may reflect the total expense of the goods we have sold, we also want to account for any other costs associated with our inventory. To accomplish this task, we must look again at our comparative balance sheet. Looking at our comparative balance sheet, we notice that inventory was greater last year than it is this year. In other words, part of the cost of goods sold related to prior period inventory. So we will want to deduct that amount from our cost of goods sold figure. If the opposite were true, meaning our ending inventory this year was more than our ending inventory last year, we would add the increase to the cost of goods sold figure. In this example, we do reflect a decrease, so that we will deduct that from our cost of goods sold number. Our next expense line item in the income statement reflecting potential cash payments is the salary and wage line item. This amounts to $36,400. The next step in our validation process is to record this item. But before we do, we need to make sure that this is an actual cash disbursement and not an accrual entry of expenses incurred but not yet paid for. For that answer, we look once again to our comparative balance sheet. Since we don't see any accruals for wage-related items, it appears that cash was actually disbursed for the $36,400. Therefore, we will add it to our equation. The next expense item on our income statement is depreciation expense. Since depreciation is a non-cash transaction, we can conclude that this item would not be reflected in our cash movement and does not need to be considered using the direct method. On our income statement, we also see an expense line item called Other Operating Expenses for $10,400. This too reflects potential cash disbursements. Much like our other suppliers previously mentioned, this should be added to our equation. Despite our best attempts thus far to capture all potential cash disbursements, we still don't know yet how much of these expenses reflect actual cash versus credit or accounts payable not yet paid. To figure this out, we must turn again to our comparative balance sheet. Within our balance sheet, we see our accounts payable increased by $26,000. This year-over-year increase tells us that although we reflect various supplier expenses, many of them still reflect items we have not actually paid for yet, meaning we may not have actually disbursed cash for these items. As such, we'll want to deduct this non-cash portion from our expenses. If these liabilities reflected a decrease, the implication would be that additional payments beyond our current debt were actually paid and that the additional cash disbursed would not be reflected in our current supplier expense and must therefore be added back. As we look through the remaining line items on our income statement in search of other potential sources of cash disbursements, we come across interest expenses for $9,750. We will add this expense as a cash disbursement and be sure to capture any potential accrual related to this amount in our figure as well. To figure this out, we will need to refer back to our balance sheet. We don't see any accrued liabilities specific to interest expenses, so therefore we can add it to our equation. As we look on our balance sheet, we do notice a line item called accrued liabilities. By definition, accrued liabilities reflect expenses incurred but not yet paid for. In looking at this item, we see the amount of these accruals last year totaled $6,500. This year, our ending balance is only $3,250, which reflects a year-over-year decrease of $3,250. What this tells us is that we must have actually paid for some of the accrued expenses in order for the balance to go down. In paying for these accrued expenses, we disperse cash, and therefore this change of $3,250 would be added to our cash disbursements equation. Much like our accounts payable figure, if these liabilities increased year over year, it would indicate that additional expenses were recorded in our numbers from the income statement, but not yet paid for, and therefore would be deducted from our equation. Our final point of validation to our cash disbursement figures relates to income tax expenses. Of course, just like we previously did, we'll want to turn to our balance sheet and see if this was accrued for or actually paid. This time we clearly see the impacting accrual and must deduct this from our cash disbursements, as it reflects a non-payment of the expense noted. As you can see, the impact of the full $9,100 accrual effectively negates the $9,100 income tax expense, netting the two amounts to zero. As we review our income statement for other disbursements not related to investing or financing activities or our balance sheet, we can clearly see that no items have been left unaccounted for. Therefore, our total of $133,900 should tie into our total cash disbursed. When we take our cash receipts for a small retail business and subtract our cash disbursements, we get a positive cash flow from operating activities of $54,600. In summary, to prepare our cash flow from operating activities using the direct method, we reviewed our cash receipts and cash disbursements journals. From those, we documented our cash movement, which was much like recording our personal cash movement into our check register. Then we verified the cash movement by validating our findings to the income statement and balance sheet. By now, you're probably seeing the complexity and the intricacy of completing a statement of cash flows using the direct method and are asking yourself, isn't there an easier way? After a brief knowledge check to make sure you understand the direct method, we'll look at the indirect method, which many consider to be a bit more sensible approach to creating a statement of cash flows.